Start the recording. Okay, fine. Anything that you would like to clarify or anything that you would like to add so far? Right. Seems you're fine, right? So let us move. Okay. Now we are coming to the content of this standard. So the one of the main things as we discuss, this standard does, it defines the fair value. It defines the fair value. So it's a very comprehensive definition. So we will look at what is the definition of fair value. It says that the fair value is the price that would be received to sell an asset. Or if it is a liability, that is the price that we would be paid to transfer a liability in an orderly transaction between market participants at the measurement date. So most importantly, it emphasized that this is a market-based measurement. It's not an entity-specific measurement. So I'm repeatedly saying that it reflects the current expectation of the market participants of the future cash flows associated with a particular asset or liability, right? So therefore, it's not an entity-specific measurement. It's a market-based measurement. So you can see that in this definition, they highlight several things. It is a price that would be received to sell an asset. So therefore, what kind of price is that? Price that would be received to sell an asset. In the sense, is it an entry price or an exit price? But they are talking about price that would be received to sell an asset. If you sell that asset, what is the price that you would get? Say that you have a land and building, a particular property. So if you are to sell that today, what is the price that you would get? If you sell that in the market today, what is the price that you would get? So therefore, it is said that it talks about an exit price. So remember, when it comes to this fair value, the price what they are talking about, it's a exit price. So when the asset going out of the business, what is the corresponding cash flow that you are getting? Or similarly, if it is a liability, the price that you would be paid to transfer the liability. So in order to take this liability out of the business, so what is the price that you would have to pay? So therefore, this price is a kind of a exit price. So if I just recall you, the previous definition what we have on this fair value, there it was used to say that it is the price at which an asset would be exchanged or a liability would be settled. That is how it was defined. The fair value in the previous definition what we had before this SLFRS 13, which was introduced in 2013. Before 2013, so what is the definition what we had on this fair value? It is the price that would be the price at which an asset would be exchanged or a liability would be settled. So there were certain confusions. So there it was mentioned that that is a price at which an asset would be exchanged. Then when it talks about the exchange, it was not clear whether it is an entry price or an exit price. But in the new standard, it made it very clear it's an exit price, right? Then another important thing, if I'm to highlight that, see, it talks about the price that would be received, right? What is the emphasis there? This is the price that would be received. In the sense, it talks about a hypothetical transaction. So here, the transaction what we are talking about, it need not be an actual transaction. It is in fact a hypothetical transaction. So why am I saying that? So if you can recall, what is the role of fair value? Earlier we discussed about the role of fair value. Then let's think about the PP. You have a particular land. Then at the reporting date, let's say that you want to fair value that. Then when you are going to fair value, you are going to take what is the price that you can obtain if you sell them in the market. Then that is for the measurement purpose, isn't it? Are you really want to sell that asset on that date? A land එක ඇත්තටම අපිට විකුණන්න ඕනේ වුණාද ඔය කියන reporting date එකට? No. We just wanted to come up with a particular measurement. That's all what we wanted. We want to subsequently measure them at fair value. So therefore, here we are talking about it's not an actual transaction. We are talking about a hypothetical transaction. If we sell that asset, how much we would get, right? That is another important thing. It's a hypothetical transaction. This is all for the measurement purpose. We agree that the fair value, it's a measurement basis. So therefore, it is just for the purpose of measurement. We want to come up with a measurement. So whatever the assets that you would have at a particular reporting date, you don't want to sell that. Whatever the financial asset, whatever the investment that you would have, you don't want to sell that. You really want to measure them, right? The PPE, you want to measure them. The investment property, you need to measure them. The financial asset, you want to measure them. So hence, it is a hypothetical transaction. If you sell them today, how much you would get, right? That is another important thing what it highlights. And it talks about the asset or a liability. So that is the subject of measurement. It's a asset or a liability. You can talk about an instance where you want to fair value an asset, or either you want to fair value a liability. So that is another important aspect. And also, it talks about an orderly transaction. What is the emphasis there? Why they are mentioning about the orderly transaction? Again, this was to eliminate one of the limitation in the previous definition. That it was not clear what kind of a transaction is it. The orderly transaction is a transaction which is not a forced transaction. So you want to emphasize here, it's a very orderly transaction. It's a transaction that assumes a kind of a market exposure. So it is the whatever the marketing activities that is customary for that particular asset, you have the time to do these activities before you sell that asset. So let's say that you are going to fair value a particular kind of a land. So in that particular instance, when you're obtaining that fair value, so you have a kind of a time that is required to do the marketing activities or whatever the thing. So therefore, under normal circumstances, you are entering into this transaction. So it is not a distress transaction. It is not a forced transaction. So when it comes to a kind of forced transaction, you know, there it may not be the fair value. So it can't be the fair value because you are in a hurry. You are selling the asset under urgent circumstances. So you have seen that in some advertisements. So we are selling this asset මුදල් හදිසියකට වත් මේ වාහනේ හරි මොකක් හරි this motor vehicle is sold. So එතන තියෙන්නේ kind of a distress transaction නේ. ඒතකොට එතන කතා කරන්නේ orderly transaction එකක් නෙමෙයි. ඒතකොට transaction එකක් orderly නෙමෙයි නම් එතන තියෙන price එක fair value එක වෙන්න බෑ. If someone force you to enter into this transaction, it can't be the fair value. So if you are entering into a kind of a distress transaction, you are in a kind of urgency, yes, that is also not the kind of a fair value, right? So therefore, here we are talking about the orderly transaction. And also, it is between the market participants. So the buyers and sellers, they are willing, knowledgeable, able, and independent. They have all these characteristics. They are independent, not related parties. They are willing, and also they are able, right? And also they are knowledgeable. So they are pretty much aware of the transaction as well as the market condition. So they are pretty much knowledgeable. So we are talking about the market participants. And also, what is the date of measurement? It is at the measurement date. It is either at the measurement at initial recognition or subsequent measurement. It is at a reporting date or it is at the measurement at initial recognition. So it specifies everything. So having understood the limitation of the existing kind of fair value definition, they have switched to this new definition. So I would say that it's a very comprehensive, precise definition. It talks about the exit price. It talks about a particular asset or liability. It's a hypothetical transaction. It's not a forced transaction or a distressed transaction, and it is between the market participants and at the measurement date. So that is the definition of fair value. You assume a market transaction, right? So now what we are going to do, we are going to take each of these major elements, I would say, the key parts of the definition, and we'll be looking at them in little detail, right? Okay. දැන් අපි බලමු මේ definition එකේ තිබුණ එකේ කොටස් අපි අරගෙන සාකච්ඡා කරමු මොනවද ඒවා යටතේ තියෙන්නේ කියන එක. Right, before moving on to that, are you clear with this definition to a certain extent? Is that clear? Are there any confusions? I would say, would like to know the things what I mentioned, that the things that you're not convinced, you can question on that. Clear, right? Okay, good. So let's see.
Sir, excuse me. Selling of investment property.
Yeah.
Selling of investment property comes under the orderly transaction of fair values.
Here basically orderly transaction means it's a kind of transaction you are entering under normal circumstances.
Yes.
In the sense that whatever the transaction, we assume that, you know, when it comes to certain asset, we need to do a kind of a customary marketing activities. No, so let's say that you are selling kind of land. If you are to sell that particular land, usually you need to place a kind of a advertisement in the newspaper, or advertisement, maybe a web advertisement, or maybe a TV commercial. So whatever it is. So this orderly transaction means a transaction that assume enough market exposure, because this is about a kind of market transaction. So you assume that, so here you have the enough time to take that particular market exposure. You can aware the market about this particular product, and thereby you can get a kind of a enough participants, the buyers for that, and then out of that the price emerge, something like that. So that's what we call the orderly transaction. So therefore, when it comes to investment property, it is basically the land and building. So whatever the property that you may be selling, so if you can assume at the reporting date, you know, usually you are measuring them at the reporting date, it may be 31st March. So when you are going to measure that particular kind of investment property at that particular date, you are assuming that, let's say that it is customary for a investment property to be advertised for a period of 1 month time. So we are assuming that you have taken that particular period, you have done whatever the advertisement, whatever the promotional activities, and thereby on the measurement date, you are selling this particular asset. So that is the kind of assumption what we are taking. So therefore, it is not a kind of, you are not in urgency. That is the point what we are want to say. So if you are in urgency, you are selling them not at a kind of fair value. No, it may be sometimes less than that. Yeah. So therefore, for this investment property, yes, you can assume the orderly transaction.
Thank you, sir. Clear.
Yeah, good. So it is all about a hypothetical situation, right? This is not something to be done actually. This is a kind of a hypothetical situation. This is a kind of a the assumption. It is, everything is based on the assumption, because our purpose is not to sell that, no. So we are not really want to sell that investment property. Rather, we want to measure that investment property at its fair value. So that is the very purpose what we want to do. So therefore, when measuring, we are assuming under normal market conditions, we are selling this particular asset. So something like that. That's why we are saying that it's a hypothetical. It's not an actual transaction, but for the purpose of measurement, you are establishing. Good. So likewise, so it is pretty much appreciated. So the questions what you are coming up with, so it makes this discussion more lively. And also even you can add whatever the experience that you are having. Yeah. So whatever the confusion, yeah, that's a lot better. Okay. Right. Now let's look at each and every part of this. Can you explain more about the transfer liability? Yeah. So when you come to this standard itself, it is in fact uh, this standard is more towards the asset. So this standard is more towards the asset. So that's why in most of the circumstances we are taking the example from the asset side. Yes, even when it comes to a kind of a liability, that would be the same. So when it comes to liability, that is the price that you would require to pay in order to transfer this liability. So when it comes to this transfer, it can be a kind of a settlement, right? It can be a kind of a settlement, and also it is about the liabilities come to the maturity. So that can also be the case. So therefore, this transfer can be a settlement, or even it could be a kind of come to the maturity. Say that you have issued some debentures in that particular case. So let's say that it is having a kind of period of 5 years. You have issued the debentures with a period of 5 years. Then after, let's say that 3 years time, if you want to measure the fair value of that particular debenture, the fair value of that particular debenture, then in that point, so you need to look at what is the price that you would have to pay in order to transfer this liability to a market participants. If there is a kind of market in the market participant, in order to transfer that liability, how much you would have to pay? Because you know the ones who undertake this liability, that particular person would have to pay interest for the remaining period for the holder of this particular debenture, as well as at the maturity, that particular person would have to pay the redemption value. So therefore, the person who undertake this liability, he's having certain liabilities towards, he's having some obligation towards the ultimate holder of this asset. So in that sense, so when you are transferring that, in order to compensate, in order to compensate these liabilities, you might have to make a particular payment. So that payment is what we call the fair value. So if you assume a kind of market transaction, so you know most of the time when it comes to these advanced economies, even for these debentures, there is a kind of a market. There's a kind of a market for that. So in that market, at reporting date, you may be able to get what is the fair value of this debenture, and that is going to be the fair value of this liability. But in certain circumstances, that particular fair value may not necessarily be available. In that particular case, what you're going to do, you're looking at the future cash flows and you get them discounted by a market rate, and you establish the present value today, and that is going to be the value of the liability. So basically, we'll be discussing that there are certain valuation methods. So the most important valuation technique is going to be the market approach. In that particular case, the value of these assets and liabilities are available in the market. All what you have to do is just go to the market and pick the price, and that is the fair value of the liability or asset. But in some instances, this price is not readily available, but in the market rate is available. The interest rates are available. So if you have a market interest rate applicable to a particular asset or liability, then you can get the future cash flows discounted and establish the present value. So it is called the income approach. So, and that is going to be the fair value. So likewise, there are certain instances in order to measure the liability. But predominantly, when it comes to this fair value, it is applied in the context of asset, but even in the context of liabilities, yes. So that is applied even for the equity items, the liabilities and equity. Good. So did I answer your question?
Sir,
Yeah.
normal course of business is prepare and building new house and land. Then what is the effect of that standard?
So you mean that your primary business activity is constructing houses?
Selling, yes,
Yeah,
constructing house
yeah.
and
It is
sale.
basically inventory, no? So it is going to be your inventory. So when come to this inventory, inventory must initially be measured at the cost, and subsequently it is the cost or net realizable value. So no impact on this standard. So the inventory, it is not comes under this fair value, no?
Yes, sir. Thank you, sir.
Yeah, it is applicable for certain standards as we discussed, like PPE, that is one thing. SLFRS 9, that is another. LKS 40, 41, 3, 38, likewise. In those instances, yes, this standard is applicable, right? Good. So that's why we said that it is about when to measure the fair value is dictated by the other accounting standard, but how to measure the fair value is dictated in the SLFRS 30. Good. Right. Now we'll be looking at each and every component of this definition and we'll be discussing what is important there. It is said that when come to this price, it is going to be the price that would be received to sell an asset or paid to transfer a liability, as we discussed earlier. So then here also what I need to emphasize, it is about a kind of a exit price. That is the most important thing, exit price. And also it's a hypothetical transaction. That's why we are using this would be, right? And here it talks about the market principle or the most advantageous market. We'll come to that later. Forget about that for the time being. Just think about it is the price that would be received to sell an asset or paid to transfer a liability in the market, right? In the market at the measurement date under current market condition. So that is another important thing, right? So here we are talking about the current market condition because I said that the fair value reflect the current expectation of the market participants. So therefore, what is the condition that is there in the today's is what matters. It is not what is going to be the conditions in the future. So, you know, if you take the automobiles, the market for the automobiles, in the today's context, you know, the prices are really inflated. So it is because that the imports are limited, right? There are certain restrictions on the importation of the automobiles. In fact, we do not import, if I'm not mistaken. So as a result of that, you know, the market for these automobiles, it is a very inflated market. So the prices are really high. But that is the fair value because we are taking into account the current market condition. So under the prevailing market condition, we are talking about the exit price, right? Then when it comes to an asset, it focuses on the cash inflows expected to generate after the sale. You know, when we sell a particular asset, let's say it's a kind of a motor vehicle, why that market participants or the why that buyers would pay us that price, why these buyers pay a certain price for that, because having purchased this asset, this particular asset would generate some benefit for these buyers, right? Having purchased this particular asset, it generates some benefit for these buyers. So therefore the price what these buyers are paying is a reflection of, it's a reflection of the cash inflows expected to generate after the sale. නේ? එතකොට ඇයි මාකට් එකේ ඉන්න බයර්ස්ලා අපිට යම්කිසි ප්‍රයිස් එකකට අපේ තියෙන මෝටර් වෙහිකල් එක ගන්නෙ? එතකොට ඒකෙන් එයාට යම්කිසි බෙනිෆිට් එකක් තියෙනවා. ඒ එතකොට එයාලා ඒ අද ගෙවන ප්‍රයිස් එක රිෆ්ලෙක්ෂන් එකක් ඒ මේ කියන වත්කමෙන් අනාගතයේ ජෙනරේට් කරන cash flows. It's a reflection. That's why we are saying that it reflects the current expectation of the market participants, right? It reflects the expectation of the buyers about the future cash flows. You cannot hear that, right? Okay. Can you hear that now? Are you fine? Do you hear me properly? No, it's fine. Yeah. Yes, right. Okay, good. Right. Okay. So then that is about the asset. So when it comes to the liability, yes, when it comes to liability, it is the expected cash outflows by the entity. So having assume a particular kind of a liability, so there are certain cash outflows associated with that liability. So, you know, if you obtain a kind of loan, so in that, so there are certain cash outflows associated. So you need to pay that installment, right? You need to pay this loan by installment. So therefore, the expected cash outflows are there. So therefore, the liability would reflect the expected cash outflows. So it is about the price, it is exit price. So when it comes to this, the PP, so when it comes to this cost, what we have, it's an entry price, no? When it comes to the cost, when it comes to the historical cost, so there what we have is the price that we would pay to acquire a particular asset, isn't it? So the PP එකක් සම්බන්ධයෙන් අපි කතා කරොත් එතන අපිට තියෙන entry price එක. මොකද අපි pay කරන price එක. නමුත් මෙතන හැම වෙලාවකම කතා කරන්නේ price එක අපිට හම්බෙන price that we would receive. So it's a exit price. It is not an entry price, but it is a exit price. Exit price in the market, right? Okay. Then the asset or liability. So when it comes to this fair value measurement, as we discussed earlier, it is for a particular asset or a liability, or even it could be a kind of group of asset and liability. So ඒක asset එකක් වෙන්න පුළුවන්, liability එකක් වෙන්න පුළුවන්. ඒත් එකම it can be even a group of asset and liability. Simple words, it can be a particular business unit. සමස්ත business එකක් වෙන්නත් පුළුවන්. So if you can recall that when it comes to the empowerment, you would have heard that we are taking that the cash generating unit. The cash generating unit is a particular business unit. So therefore, fair value may be applicable for a group of asset and liabilities as well, right? But the most important thing is that when it comes to this asset or liability, so here, when we are going to fair value a particular asset or liability, we need to take into account the characteristics of that asset or liability that the market participants would consider in determining the price at the measurement date. So this is a very practical thing, right? When you are to fair value a particular asset or liability, you need to take into account the characteristics of that asset or liability. For example, let's say that you're going to sell a kind of a motor vehicle that you have in the business. Let's say that you are going to fair value the motor vehicle that you have in the business. අපි හිතමු ව්‍යාපාරයේ තියෙන motor vehicle එකක් අපි තියෙන කියලා හිතමු. ඒතකොට මේ motor vehicle එක fair value කරන්න අපි හිතනවා. එතකොට what are the aspects that you should consider when fair valuing of this asset? So when it comes to kind of motor vehicle, so you may be familiar. So so this is a very practical consideration. When you are selling one of the motor vehicles that you are having, or the motor vehicle that you are having, what are the aspects that you would consider? Yes, you can add that to, you can contribute to this. The one aspects I can say that when it comes to the motor vehicle sale, what the market would expect, it is about the fuel efficiency. In our context, the market would value the fuel efficiency. So it is one of the conditions that the market participants would consider. So likewise, what are the other conditions that the market would consider when purchasing a kind of motor vehicle?
Manufacturing year.
Yes, very correct. How about manufacturing year? That is going to be a consideration. The kilometers being driven. So the mileage or the kilometers that is being driven. So it is another consideration. The year of manufacture, the mileage, and as I mentioned, that is about what do you call that, fuel consumption. Yeah, and also the brand. Yes, so when it comes to a country like Sri Lanka, the Toyota is highly valued over the other brands. And also what about the maintenance cost? Maintenance cost, even the history of the model, that is also considered. And similarly, as I mentioned, that the maintenance cost, that is also a big consideration, no? The price of the spare parts. So those aspects the market would consider. Yeah, what else? Spare parts cost, yes.
Engine and body capacity,
Yes, engine capacity is valued, and the body, yeah, the size, I would say, and the value of the future markets. Yeah, even people are considering about
second-hand values. Second-hand.
Yeah,
That means
hybrid or normal. Yeah, good. So likewise, that's it. So this is it. So the manufacturing country. So likewise, so now we are taking a very practical consideration. So this is applicable when it comes to the fair valuing of a particular asset. So it is said that having taken into account the characteristic of the underlying asset or liability, you need to do the fair value. When you are doing the fair value, you need to take into account all these aspects. So that is what we highlight under this asset or liability. We said that fair value is for a particular asset or liability. So the point is that when it comes to the particular asset or liability, you need to take into account the conditions of that asset. So therefore, so this is about the rational behavior of the market participant, the economic rationality. And similarly, if you think about the land, what are the aspects that you would consider when placing the fair value for this land? The one thing is, yes, the location matters, isn't it? So if you consider about the 10 perch land near the university and the land near, let's say, the cancer hospital, right? So if you consider that, so which is going to be having the highest value? So out of that, so it is certainly the land which nears the university, no? So it is about the sentiments of the people. So people would place a greater value on that. So therefore, the location matters. So
The
when it comes to,
locations,
sorry,
location mainly depends on the purpose of the business.
yeah, purpose of the business, yeah. Yes, very correct. Yeah, you're very correct. It's the purpose. Purpose matters, no? When it comes to this location.
Yeah, purpose of the business.
Yeah.
Sometimes if it is near to the town area, if it is possible for the business type things.
Yeah, but if you put it like this, let's say that when it comes to a kind of a land, uh, so the land near the university, and the example I took, the land near the, let's say the Maharagam Cancer Hospital, let's say it is very identical land. So when it comes to that land, it's a 10 perch land. It is very identical in almost all the aspects. But still there is a difference in the price other than the purpose, isn't it? Don't we see that? Uh, would we see that the market placing the same value, or is it different? Different value, the location. Or otherwise, if I'm to give an example, let's say that the same land, the two plot of land near the university, let's say. So one is located in front of the university, the other one, let's say, it is in the backward to the university, right? When the things are such, let's say that the government, let's imagine, right? The government is going to use a nearby land as a garbage site, right? The government is going to use a nearby site. So let's say the land which is located backward the university, right? So near that, a nearby land is going to use as a kind of garbage site. If that is the case, earlier it was having kind of a similar price. So irrespective of the location, because it is near to the university, irrespective of whether it is in front or whether it is back. So this more or less the same price was there. Now, if the government is going to take the decision that if they are going to form a nearby land as a kind of a garbage site, what would happen? The sentiments of the people is going to get changed, isn't it? So certainly the value of the nearby land is going to be dropped. So hence the point what I was trying to say is that the location itself matters. The location itself matters. The location කියන එක consider කරනවා නේද? The point what you are making is very correct. The purpose. But the point is that if we take the purpose, it is going to be entity specific, right? Entity specific characteristic. But here we are talking about the market situation. So therefore, the location is a kind of a one characteristic that we can consider. The what market would consider, right? Yeah, you have said that different geographical matters. Yes. The deed the clearance of the deed, that is also another factor that would consider, and also the access to the infrastructure. So you would have seen that when advertisements are placed, you can access to the highway in 5 minutes, something like that. That itself has a value. So it is about the access to the infrastructure. That is also another factor what the people would consider when it comes to the land, asset like land, right? And also, yes, the geographical matters, yes, geological matters, yes, we consider that. So likewise, there are certain factors that the people would consider when it comes to asset like land, right? So all these things are very practical aspects, right? You need to think of then, that is in fact what we need to take into account when fair valuing the asset. And not only that, even you need to take the restrictions into account. So in some instances, so if we consider that in certain areas, when you're going to construct building, there's a maximum height that you can go. The market participants would even consider that. So especially when it comes to the university, right? If I'm taking the examples from the university, there's a maximum height which we can go, because the Ratmalana airport is situated nearby, and there is a kind of airway. It is above the university premises. So therefore, the maximum height what we can go in our construction, in our buildings, there's a certain ceiling. So that is also considered by the market participants. So that is a kind of important restriction. Yes, another thing what you have mentioned, that the purpose that the land was used. Yes, in that, in fact, we are going to discuss them in detail. The purpose matters out of the many purposes, right? Here, the most important thing, very good concern. So the purpose matters when it comes to the different purpose of that particular land or whatever the asset. You are going to refer to the highest and best use. That is what we consider. So later we will be discussing when it comes to this asset or liabilities. Yes, as you mentioned, when it comes to a particular asset, there can be different purposes. So let's say that it's land. You can either use this land for agricultural purpose. You can either use this land for industrial purpose, or you can use this land for what you call the residential purpose. You can do a kind of apartment, and you can use that for the residential purpose. Likewise, different purposes are there. Out of that, when you are fair valuing, what is the use that you are referring to? That is the highest and best use, right? Yes, the purpose matters, but out of that, it is the highest and best use. Good. The local authority requirement, very correct. When it comes to restriction, that has to be considered. So there are certain lands which you cannot use for the residential purposes. So it is restricted. There may be certain certain lands which is allowed to be used for agricultural purposes. It is not allowed to be used for the residential purpose. So, but if you find that, so if we use this particular plot of land to construct a kind of housing apartment, we can make big money out of that. But still, from a legal point of view, it is not allowed. It is not allowed. So the restriction matters. So therefore, even though the highest and best use is provided by the residential purpose, but you cannot go for that use. So you need to go for an alternative purpose. Yes, very correct, right? You are taking a very practical point of view. Appreciate it. Good. How the ownership transferred up to now. Yeah, that is also a kind of a aspect that is being considered highly valued. No, it is more or less you are talking about the legal aspect, right? Good. So this is about the assets or liability. Remember, this is important. The characteristic of the underlying asset or liability must be taken into account. So as I said, this asset or liability can be a kind of standalone asset, or as I mentioned, it could be a kind of a group of asset. So this is what we call basically the unit of account. The unit of account, again, this is something that is dictated in the accounting standard, right? In the accounting standard, the different accounting standards would dictate what is the subject of measurement and what is the unit of account. So when it comes to standard like SLFRS 9, it says that it is financial instrument that is the subject of measurement, and the unit of account it would dictate. It would dictate. Uh, then when it comes to standard like LKS 36, the impairment of asset, there we discuss about instances of carrying out the impairment at the business unit level. So we call it the cash generating unit, but in a practical point of view, it's a particular business organization. So when you find that it is difficult for you to determine this impairment on an asset by asset basis, so then you can go for a kind of group of asset or liability. Then you can consider the entire business. Then for that particular business, the value of the business, you can decide what is the value in use and the fair value less cost to sell. Then you can go by the higher value. So if you find that the recoverable amount is less than the carrying amount of the business, then the impairment is there. So therefore, this is a something that is dictated by the other accounting standards, whether it is an asset or a liability. So a standalone one, or is it a kind of group of asset or liabilities, right? Then we talk about the orderly transaction. This is something I mentioned earlier, but now we are going to looking at in detail. So when it comes to this orderly transaction, it's a transaction that assumes exposure to the market for a period before the measurement date to allow marketing activities that are usual and customary for the transaction involving such asset or liabilities, and it is not a forced transaction. So it highlights two things. One is that it is not a forced transaction, or it is not a distressed transaction. You know, if it is a forced transaction, a distressed transaction, it can't be a kind of orderly transaction. So the fair value you cannot find over there. So make a forced corrupt transaction, fair value. So it is not the case. And again, if it is to be an orderly transaction, it says that it is a transaction that assumes exposure to the market for a period before the measurement date to allow marketing activities that are usual and customary for the transaction. You know, when it comes to certain assets like motor vehicle, the land and building, the investment property, right? For these assets, you know, it is customary or it is usual to undertake certain marketing activities. No, you need to advertise, you need to put an advertisement. So usually if it is a kind of motor vehicle, if you place an advertisement in a website like the ikman.lk or something else, you would be able to locate a buyer probably within 2 weeks time sometimes, or even it may be in 1 month's time, something like that. So there are very customary or usual marketing activities. So the transaction, what you would assume, is a one that allow to get enough market exposure through these marketing activities, and under normal circumstances, you may be engaging selling this particular asset. So it is a orderly transaction. So again, remember that here we are not talking about a kind of actual transaction. So it is about a hypothetical transaction. When it comes to that hypothetical transaction, we assume it is a kind of transaction which we are taking enough market exposure, and then only we are selling. In simple words, we are locating enough buyers. We are locating enough buyers, and then only we are selling them. So therefore, that is going to be the fair value. That is going to be the price. The price what is decided in that market, it is going to be the fair value. Right? That is about the orderly transaction. When it comes to this orderly transaction, even earlier we discussed, when it comes to this market, we talk about the two markets, right? This is important. If you can recall, earlier I simply ignore that. From the time being I discussed that, that's what I said to you. So here you can see that when it comes to this market, we can talk about the principal market or the most advantageous market. This fair value is decided in either of this market. Either of this market. In the sense, the very first thing what you need to look for a particular asset or liability, if there is a principal market, you need to take the exit price in the principal market. You need to take the exit price in the principal market. That is what we call the fair value. For a particular asset, there can be certain markets, no? So for an example, if you take a kind of particular product, there can be some wholesale market. There can be a retail market, and there can be a export market. So likewise, there can be different markets for a particular asset. Then out of that, one market can be the principal market. And what is that market? The principal market. It is the market with the greatest volume and the level of activity for a particular asset or liability. You know, each of these markets, there may be a certain market transactions. By referring to this market transaction, the volume of the transaction, you can see out of these three markets, there can be in one market which produce you the greatest volume. Let's say when it comes to this wholesale, when it comes to this retail, and when it comes to this export market, let's say the market volume, let's say that there are 100 transactions in the wholesale market, and let's say that there are 250 transactions in the retail market, and there are 50,000 transactions in the export market. Then out of these three markets, right, if you have access to these three markets, then what is your principal market? That is the market with the greatest volume and the level of activity. And what is that? That is the retail market. In the retail market, as I said, there are 250 transactions. So therefore, when you are looking at the fair value, you need to refer to this principal market, that is the retail market in our case, and take the fair value referring to that market. So therefore, remember, the fair value is, in simple words, the exit price in the principal market. Right? So that is what we call the fair value. Then what about the most advantageous market? You know, in some instances, for a particular entity, they may not have access to this principal market. For a particular product, there's a kind of a principal market. For the principal market, a particular entity may not have the access. Right? You know, in certain markets, the access is limited. Right? So access is limited to certain parties. So let's say that in the instance, what you may assume, you don't have access to this retail market. අපි retail market එකේ transactions කරන්නේ නැහැ කියලා. අපිට ඒකට access එක නැහැ. ඒතකොට අපි transact කරන්නේ in the wholesale market එකේ සහ export market එකේ. ওই දෙකේ විතරයි. So in such an instance, even though the greatest volume is produced in the principal market, you don't have access. Then what is the option you got? You cannot refer to the principal market. The principal market එකට ඔයාට refer කරන්න බෑ. So one instance is that if you don't have access to the principal market, then you may have to look for an alternative. The other thing is that, you know, when it comes to this principal market determination, how I determine this principal market, that is by referring to the volume. Let's say in a given instance, this volume information is not available in the market. No one knows the volume of the transaction carried out in each of these markets. It is not being recorded. It is not available. That information is not available. If that is the case again, you cannot search for a principal market. So likewise, in these two instances, in the absence of a principal market, it is because you don't have the access, or sometimes in the absence of the volume information, you need to refer to the most advantageous market and decide the fair value. And you need to get the value, and that is the fair value. So that's why we are taking, when it comes to this market, yes, we first look at whether there is a principal market. In the absence of a principal market, we are referring to the most advantageous market. So therefore, the fair value is basically the exit price in the principal market, or in the absence of a principal market, you can say it is the exit price in the most advantageous market. Then how do you decide the most advantageous market? එතකොට කොහොමද most advantageous market එක අපි decide කරන්නේ? The most advantageous market is determined. It is a market that maximizes the amount that would be received to sell the asset or minimize the amount that would be paid to transfer the liability after taking into account both the transaction cost and the transport cost. When it comes to this most advantageous market, it is said that so you get the sales proceed. If you sell that in that market for a particular asset, you get the sales proceed. From that sales proceed, you need to deduct the transportation cost and the transaction cost. And basically, we call it what you get is the net proceed. So therefore, in simple words, the market that gives you the highest net proceed for a particular asset is going to be the most advantageous market. The market that gives you the highest net proceed. Then out of the two markets, you have this wholesale market and the export market. Then you need to look for the net proceed. The market which gives you the highest net proceed is what we call the most advantageous market. Then once you identify the most advantageous market, you need to work out the fair value. Fair value is not equal to the net proceed. The fair value කියන්නේ net proceeds වලට සමාන නැහැ. Right? Net proceed work out කරේ ඇයි most advantageous market එක හොයාගන්න. Then this is what we call the transaction cost. The cost to sell an asset or transfer liability in the principal or the most advantageous market for the asset or liability that are directly attributable to the disposal of the asset or the transfer of the liability. So we call it is a kind of an incremental cost, transaction cost. If you are to enter into a transaction in that particular market, you need to incur that particular cost. It's a transaction cost. So you might find that to enter into transaction in some markets, you need to pay a particular price. So you need to pay a particular commission. You need to pay a particular kind of a tax. The stamp duties, likewise, the certain transaction cost is associated. So it is a kind of incremental cost. If the transaction is not there, the cost is not there. So if the transaction is there, the particular cost is there. So that's why we call it the incremental direct cost. Would not have been incurred had the decision to sell the asset or transfer the liability not being made. So if the transaction is not there, basically this transaction cost is no, right? So it is a kind of incremental cost. So even in the share market itself, there are certain transaction costs for each and every transaction that you may perform. So whatever the market that you would take, you would find the transaction cost is there. Then what about the transport cost? It is pretty obvious. It is the cost that you incur to transport a particular asset from your current location to the market. It can be the principal market or the most advantageous market. So basically, whatever the product that you would have, you need to take that to the market and then you need to sell that. So it is about the transport cost. So when it comes to the calculation of net proceed, it is specifically said that you need to deduct both the transaction cost and the transport cost. එතකොට යම්කිසි වත්කමකින් අපිට ලැබෙන net proceed එක තීරණය කරනකොට ඒ වත්කමින් විකුණලා අපිට ලැබෙන මුදලෙන් transport cost එකයි transaction cost එකයි අපි අඩු කරන්න ඕනේ. ඒක තමයි net proceed එක කියන්නේ. ඒතකොට net proceed එක වැඩිම market එක තමයි most advantageous market එක. ඒතකොට පළවෙනි option එක තමයි අපි principal market එකක් තියෙනවද බැලුවා. If we don't have the principal market, then only we are going for the most advantageous market. The most advantageous market is a market which gives you the highest net proceed for a particular asset. With the liability, that is the market which minimizes the amount that you would have to pay. Then what is the fair value? Then it is said that when it comes to this transaction cost and the transport cost, both are used to determine the most advantageous market. Yes, we agree. However, the price used to measure the fair value is not adjusted for transaction cost. This is important. You can see that when you are going to derive the fair value, it is a matter of sales proceed minus the transport cost. You are not allowed to deduct the transaction cost when you are arriving at the fair value. Or in other words, the fair value is free from transaction cost. Why is that? Why you are not allowed to adjust the transaction cost when you are deciding the fair value of a particular asset or a liability Why is that? The transport costs are deducted to calculate the fair value. So you are allowed to deduct the transport cost, but not the transaction cost. Transport costs are allowed, but not the transaction cost. So what is the logic behind that? So what is the rationale that the standard would provide? So it is something, in fact, you have already learned. So earlier, if you can recall, so when we are talking about the fair value, we agree that, so we need to take into account the characteristic of the asset or the liability. It is not about the characteristic of the market. So if you consider about this transaction cost, transaction cost is a characteristic of the market itself. It is not something to do with the asset. So whatever the asset that is being sold in that market, subject to the transaction cost. So then it is not a characteristic specific to the asset. It's a characteristic of the market. And that's why we are not allowed to adjust for the transaction cost. So අපි කලින් කිව්වා යම්කිසි වත්කමක් හෝ වක්කීමක් fair value එකට ගන්නකොට අපි consider කරන්න ඕනේ characteristic of the asset or liability කියලා. ඒතර මේ transaction cost කියන එක අපි ගත්තොත් transaction cost කියන්නේ asset එකේවත් liability එකේවත් characteristic එකක් නෙමෙයි. ඒක market එකේ තියෙන condition එකක්. So therefore it is nothing to do with the asset or liability. Hence you cannot adjust for the transaction cost when you are deciding the fair value. But you can adjust for the transportation cost. Why is that? Because the location is what gives rise to the transport cost. So the location, we agree that it's a characteristic of the asset. So if it is a characteristic of the asset, then we must allow to deduct the transaction cost. So hence, yes, the transportation cost is allowed. So that is the underlying argument for that. So therefore, remember, when it comes to the fair value measurement, so you take the sales proceed from a particular asset, that is the price that you would get from selling a particular asset in the market, and then deduct the transport cost, and that's what gives you the fair value. But when you are deciding on the market, it is on the basis of net proceed. So in that, both the costs are deducted to decide the market. So once you agree on a market, and then you need to deduct only the transport cost from the sales proceed to arrive at the fair value. So that is the whole story is about. So let's go for one example, and thereafter we can have a break. So we've been discussing this for long. We can quickly do this activity. මේ activity එක අපි කරලා පොඩි break එකක් අරගමු. මේ slide එක discuss කරන්න අවශ්‍යයි. මේ slide discuss කරලා break එකක් ගමු එතන. So point 2, right? Okay. So let's look at that. An asset XYZ is sold in two markets. For a particular asset, there are two markets called market A and market B, and the price is given. If you sell that particular asset in the market A, you can sell it for 27 million. If you sell them in market B, you can sell the same asset for 26 million. The volume of the transaction in each of the market is provided, 10,000 and 8,000. Transaction cost, transportation cost is given. Then it asks you first, what is the principal market of the asset? Yes. Tell me what is the principal market in no time. What is the principal market?
Market A.
Yes. So why do you say so? Yes, you are correct. So what is the reason for that? It is the market with the highest volume. It is the market with the highest market volume. That's it. Yes, highest volume. Very correct. Good. Very correct. Then what is the fair value of the asset? What is the fair value of the asset? Yeah, in no time. Yeah. It's going to be 24 million. Okay. So let's see how you get that. it is going to be fair value is, you know, it is the exit price in the principal market. So the principal market is A. So therefore, what is the exit price? It is a price minus the transport cost. 27 minus 3, very correct. It is going to be 24. Yes, yeah, exactly correct. Then it asks you, what is the fair value of the asset in the absence of the volume information? If the volume information is not there, what is that? Yes, market A is 27 minus 3, 24, very correct. Then it asks you, what is the fair value of the asset in the absence of the volume information? If you assume that the volume information is not there, what is going to be the fair value? That is the question is about. So if you don't have the principal market, then what you have to do? You need to go to the most advantageous market. Then what is the most advantageous market? That is the market which maximizes the sales proceed. Then you need to work out the sales proceed and see net proceed and see which gives you the highest net proceed. No, if I want to do that, so then අපිට work out කරලා බලන්න වෙනවා මොන market එකේද අපිට හම් වෙන්නේ. So let me take that. Yeah. So if I want to take a particular called net proceeds, so you need to look for this net proceed in order to see which gives you the highest. No, this 27 minus 2 minus 3, it's going to be 22 million. 22 million over here. So here you have 26 minus 2 minus 1, it's going to be 3. It's going to be 23 million. So then you can see that the most advantageous market is what? It is the market B. So once you identify the most advantageous market, then referring to that, you need to work out the fair value. Then in this market, how you take the fair value? It is 26 minus 1, as you have very correctly shown. It's going to be 25. Very correct. Yes. So that is the most important concepts, right? In fact, this is something what we can test even in case of your examination. So if you have get this concept right, yes, you have achieved, you have understood what we have discussed so far. This is the very essence. So this is a very important thing that you need to understand. මේක තමයි මෙතන තියෙන වැදගත්ම point එකක් ඔයාලා මේ understand කරගත්තේ. So if you are clear with that, then that's great. So if you have questions on that, yes, now it is the time for you to raise that. මෙතන ප්‍රශ්න තියෙනවා නම් අහන්න. Would you be fine with that? So it seems that you are fine. And so if you are to have an understanding of your exam type question, so here at the end, I have included a question. So this is your exam type question. So it is in the 33, the slide number 33. So there we have exam type question. And if you can manage something of this nature, that's it. So if the time permits, even we may go through that. Or otherwise, I might simply provide you a rough guidance on how to answer a question of this nature. Right? Okay. So during the break, if possible, just have a look at that, right? Okay, before the break, I just want to take one last slide, and yeah, so it is about the market participant. So we've been discussing about the key parts of the definition, and this is going to be the last part. And when it comes to the market participants, it is about the buyers and sellers in the principal or the most advantageous market. So now you know the market, right? For the asset or liability with the following characteristic. So when it comes to these market participants, we are assuming that they have the following characteristics. They are independent, they are knowledgeable parties, in the sense they have a reasonable understanding about the asset or liability and the transaction. They are able to enter into the transaction, right? They are not just willing, but they are able, right? So there may be certain parties in the market that who are willing to, right? There may be parties who would be willing to purchase the latest edition of iPhone, but if he or she is not able, then he is not a market participant. So the willingness itself may not help, but you have to be able. So therefore, all these conditions must be there. So when it comes to independent parties, if the particular transaction being carried out between the related parties, in that instance, the price may or may not be the fair value. So sometimes you may be selling something below the fair value, right? So therefore, uh, the related parties cannot be a market participant. So therefore, they have to be independent, the buyers and sellers. And the buyers and sellers must be knowledgeable. They are having kind of reasonable understanding about the transaction as well as the underlying asset or liability. And they are able and they are willing. And uh, all these market participants always try to maximize their gain. So that is what we call the economic rationality. So throughout this discussion, you need to assume that we are talking about a rational economic person. So the one who tries to maximize their own gain. The participants, the buyers are trying to maximize their gain. The sellers are trying to maximize their gain. So therefore, the intersect of this interest of each of these parties, that is going to be the fair value. So that is the point at which the transaction being carried out. So it is the intersect of the best interest of the buyers and sellers. So it is about the market participant. So with that, we finish the discussion on the basic components of the definition. So that is in fact the first part. So after the break, we'll have a quick break and continue. We are going to discuss the practical approach to this fair value measurement. So if you are given a particular asset, so if you've been asked to fair value that, then how you should do that. So that is what we'll be discussing next. So that is also important. We may have a quick break, say that, shall we have a 10 minutes break and continue? It's 50 minutes past 7. So let's take 10 minutes break and continue, right? Okay.
Okay, it's enough, sir.
Sorry, I couldn't hear.
It's enough, sir. 10 minutes. Sir.
Yeah, okay, we'll have a 10 minute break and continue, right? Okay, good. Hope you have come back. So shall we continue the rest of the discussion? Right. So in the initial part, we basically discuss the definition of fair value and the matters arising from that particular discussion. And now we'll be moving on to another important aspect. It is about the fair value measurement. It's a practical. So in practically, how you are to measure the fair value of a particular asset or liability. So if you come up with an instance where you need to measure the fair value of a particular asset or a liability, then how we are to do so. So that's what we are going to discuss. So in fact, this is what we call the 4-step model. So there are 4 most important steps are involved. So we are going to take one by one and we are going to discuss them. So starting from the first step, when you are to fair value of a particular asset or liability, it says that you need to determine the asset or liability, or we call it, that is the subject of measurement. So in fact, by now we have discussed this. So, the starting point is about determining what is the subject of measurement. So as we discussed earlier under the definition, so there also we see this asset or liability, then we agree when you are going to fair value a particular asset or liability, you need to take into account the characteristic that the market participants would take into account when pricing asset or liability. So there we discussed that the market participants would consider the condition of the asset. If it is an asset like motor vehicle, especially, the market participant would consider about the location. If it is asset like a land, and even the restrictions on the sale or use of the asset is considered. And together with that, you need to think whether it is a standalone asset or is it a group of asset or liability. Or in other words, it's a kind of a business in the sense, the cash generating unit. So these are some of the aspects what we have extensively discussed. Here also, that is the starting point. So අපි ප්‍රායෝගිකව යම් කිසි වත්කමක් ව්‍යාපාරයේ තියෙන වත්කමක fair value එක decide කරන්න යනවා නම් මුලින්ම you need to consider the characteristic of the asset or liability that the market participants would take into account. It's a very practical aspect. So that is where you need to apply your professional judgment. So the judgment involved, right? Then the second step, it is about determining the valuation premise that is appropriate. Even I have just mentioned that, if you can recall earlier. So when you are talking about the purpose of a particular asset, I told you that out of this purpose, you need to take the highest and best use. So, you know, when it comes to a particular asset, there can be several uses. The classic example that I take, it is a land. If you take a particular plot of land, you can either use it for agriculture purpose, or you can use it for industrial purpose, in the sense you can construct a factory and you can make some product out there, or you can use it for kind of residential purpose. You can do an apartment over there and you can use it for residential purpose. So likewise, when it comes to a particular land, it can be used for different purpose. Particular asset, it can be used for different purpose. So out of this different use, what is the use that we are referring? It is about the highest and best use, which gives you the highest value. It is said that the use of a non-financial asset by market participant that would maximize the value of the asset or the group of assets and liabilities within which the asset would be used. So it is basically applicable for a non-financial asset. Why is that? You know, if it is a financial asset, there are no alternative uses. So if you take, for example, shares, it's a financial asset, the investment in shares. So yeah, there you do not find the alternative uses. That's why it is highlighted here. We talk about the non-financial asset. As far as the non-financial asset being considered, you would find the alternative uses, right? So in fact, that is being highlighted over here. Now you know what is the reason for that. It is about the highest and best use. Then it says that when it comes to this highest and best use, it has to be physically possible. So when you are assuming this highest and best use, if it is a kind of machinery, so you need to certainly consider about the condition of that particular asset. So whatever the output that you would assume, that has to be physically possible. So you must be realistic and also legally permissible. So whatever the use that you would consider, it has to be a legally permissible use. For example, I told you that when it comes to the certain lands, you may find that there are certain restrictions being placed by the authorities. The some of the lands, you cannot use it for residential purpose. If that is the case, even though the residential purpose may give you the highest and best use, you can't go for that particular use because it is beyond the legal boundaries. So therefore, whatever the use that you would assume, it has to be legally permissible, right? Uh, that is another important thing. Even you can think of illegal activities, right? For certain asset, there can be, but we are not talking about that. It is all these things within the legal limits. Yeah, what do you mean by that? The crown land? Yeah, I didn't get that. What is that, Buddha? Yeah. Can you little explain that? And also, whatever the use that you may assume, it has to be financially feasible. Financially feasible. So, the highest and best use, what you may assume, it has to be physically possible, legally permissible, and financially feasible, right? So, it is what you need to consider over here. Then it says that the highest and best use is not based on how the entity is currently using it or not using it. This is most important thing, right? When it comes to this highest and best use, sometimes your current use may or may not be the best use. So for an example, the land what you may be having, you may be using it sometimes for industrial purpose. Let's say that in the land what you may consider of taking the fair value, currently you would have constructed a kind of a factory over there. You may be doing a particular product. You are manufacturing a particular product. But from a market point of view, this land is more suitable for residential purpose. So instead of having this factory over there, if you demolish this factory and construct a residential project, residential apartment over there, so you may make the best use out of that. So therefore, we always emphasize that when it comes to this fair value, it's a market-based measurement. Market-based measurement. So therefore, it doesn't matter how you use it or not use it. It doesn't matter. So you are thinking about the highest and best use. So the current use may or may not be the highest and best use. But when it comes to the valuation, the fair valuing, you need to refer to the highest and best use. It is interesting point, right? It is based on the perspective of the market participant. The example what I mentioned, the land on which a factory currently stands could be used for residential housing development. So therefore, the current use is not the highest and best use. So we don't care about that. Why? Because we are taking a market point of view. It is not the entity specific thing. It's a market-based aspect. And also, the standard says that when it comes to this valuation premise, when it comes to this highest and best use, it can derive in two ways, right? Sometimes you may be able to obtain the highest and best use if you use this asset as a standalone asset, right? What I'm saying, when it comes to this highest and best use, it can derive in two ways. The one way is that the market would be able to get the best use if they use a particular asset on a standalone basis. In that sense, assume that the land what we are having currently, there we have a factory over there, right? Currently, what is the use we are taking? It is a industrial use, right? We are running a factory over there. Therefore, we are doing a kind of output and thereby we are making some money from that. But when it comes to this particular land, market would find that they find that the nearby land prices are continuously going up. So hence, a particular investor or set of, there can be a segment of market, they would find that if we use this particular land for the residential purpose, we can make best out of this land. So in that case, when it comes to this market participant, they find they can maximize the value of this, maximize their benefit by using this asset, using this land on a standalone basis. In the sense, currently there's a factory over there, but the market does not value that factory. So what they would find, that they would find the value comes purely, or value comes mainly from the land. So therefore, when they are placing a price, they would be placing the price considering the land itself. They are not considering the building. They don't have a concern about the factory. So the market එකට පේන්න පුළුවන් මේ යම්කිසි building එකක් sorry මේ land එක අපිට මේකෙන් වඩා වැඩි වටිනාකමක් ගන්න පුළුවන් මේ land එක අපි අරගෙන factory එකක් තියෙන land එක අරගෙන factory එක demolish කරලා දාලා අපි මේ land එකේ හදනවා housing project එක residential purpose එකට. So if you do an apartment, then we may be able to make best out of this. So that is how the market would perceive. So therefore, market would mainly see the benefit out of the land. They don't have concern. They don't value the building, what is over there, the factory, what is over there. In factory again, value. So therefore, they basically see the value comes from the land itself. That's why we call it the standalone valuation premise. Then what is the in combination valuation premise? It is when the market participants would obtain the maximum benefit principally through using this asset in combination with other assets and liabilities as a group. In that particular sense, the market would perceive that. So when it comes to fair valuing this land, the market would perceive that, yes, if we continue to run this factory, which is located in this land, we may be able to make the best out of this land. That is what their judgment. They find that, so we better continue to run this factory in these premises. So if we continue to run this factory in these premises, we may be making the best use out of that. So in that particular instance, what is the use they are seeing? That is the current use, right? They think of continuing the current use. So therefore, in combination, in other words, I can say that it is about the current use, right? එතකොට මාකට් එකේ මේ ලෑන්ඩ් එකේ වටිනාකම දකින්නේ කොහොමද? අපි මේ ලෑන්ඩ් එක මේ ෆැක්ටරි එක රන් කරොත් මේ ලෑන්ඩ් එකේ මේ ෆැක්ටරි එක රන් කරොත් අපිට මේ ලෑන්ඩ් එකෙන් best possible benefit එක ගන්න පුළුවන්. ඒතර ඒ කියන්නේ ඒක in combination, right? The market would see the benefit in continuing this as a business. Together with the factory, together with the machinery what you have, together with the other liabilities, in considering everything, you see the benefit as a whole. It is not just the land that the market would value, it is the business that the market would value. But remember, here your subject of measurement is still the land, right? අපි තාමත් කතා කරන්නේ මේ land එක ගැන. අපි බලන්නේ මේ land එකේ වටිනාකම ගන්න පුළුවන් විවිධ විකල්ප. එකක් ඒක stand alone වෙන්න පුළුවන්. කෙනෙක්ට හිතෙන්න පුළුවන් so we can demolish this particular building and do a residential apartment, or otherwise we can run this as agricultural land, so we may be making the benefit. So therefore those are standalone uses. They standalone නේ. The market එක basically benefit එක දකින්නේ land එකේ. නමුත් in combination එකේදී මෙයාට පේනවා මේ land එක currently occupy වෙලා තියෙනවා යම්කිසි කාරණාවකට යම්කිසි දෙයකට. ඒතර industrial purpose එකට occupy වෙලා තියෙන්නේ. So ඒ use එක continue කරොත් just we can make the best out of this land. So our purpose is fair value in the land, but we see the benefit primarily in combination with the other assets and liabilities. Or in other words, it is called the in combination or in the current use. The current use valuation premise. The technically correct term, it is in combination, right? The asset will be sold as an individual asset, not as a group, but will be used by the market participant in conjunction with the other assets. So we are still thinking about the land, but the market would make sense as a business. It is what we call the in combination. So this is little tricky, but if you get them clear, so that is the most important thing. The other main area what I really wanted to emphasize you. Is that clear? Or would you like to add something, or would you like to get some clarification? What's your thought on that? Does that make sense? This is again an area which is highly likely to test in case of the examination. So therefore, your clarity in this concept is pretty much important, right? You must be clear with, yeah, okay, good. Right, then we'll do it like this. We may put it through an example, right? Okay, see, in a business combination, an entity acquires a land on which a factory stands. So the same thing what we discussed so far. The land is currently developed for industrial use. The nearby sites have recently been developed for residential use as sites for high-rise apartment buildings, right? The nearby sites have recently been developed for residential use as sites for high-rise apartment building. Recent zoning changes have allowed that land is now being used for residential purpose. Even the zoning changes, there's no problem. Even you can use this land for the residential purpose, no problem with that. No legal restrictions. If the things are such, what I want to know, can you please come up with the alternative uses of this land? So referring to this case, right? You need not to imagine, but referring to this particular example, what are the alternative uses in this situation? So you would find when you read through the case, there are certain alternative uses and what those are. You can mention them. Or in other words, what are the purposes that you can use this land for? That's it. Okay, you can use it for either for industrial purpose or residential purpose. Yes, very correct. Residential purpose, building an apartment that comes under the residential purpose. Yes, very correct. Okay, and yeah. Yeah, building a mall apartment. Yes, so that's why I ask you not to use your imagination. Good, good. You are doing it really well. These are alternative uses, but I just ask you to stick to the case, stick to the information that is being mentioned. You are very correct. You are going in the right direction, but I just wanted you to confine to the alternative uses that is being mentioned over here. Yes, as you have mentioned that there are two uses. One is industrial use. The other one is the residential purpose. Very correct. Residential use and industrial use. Good. You are getting it clear. Right. One thing is this. Let me highlight. And the other thing, what they have mentioned, that is about residential use. Okay. Then out of that, now what I need to know, tell me what is the in combination valuation premise and what is the standalone valuation premise? Now you have identified two uses. Out of that, tell me what is the in combination valuation premise and what is the standalone valuation premise. Yeah, okay, good. We'll see. Dismantling and wait for the value appreciation and sell later. Yeah, that is even possible. So all the uses what you have used, yes, very correct. Industrial. Now it seems that you are going the other way around. Appreciate the effort. But again, if I'm to explain what is the standalone valuation premise, is that standalone valuation premise in that market sees the benefit, market sees that they can maximize the benefit principally through using this asset on a standalone basis, right? You know, when it comes to a particular asset, you know, it is currently occupied for a particular purpose when it comes to a business organization. Then when it comes to the market, so what matters is how the market would perceive that. So when it comes to the market, if the market sees that the benefit mainly comes from that particular asset, and that is what we call the standalone. In that sense, let's say that currently there's a factory is located in the kind of land. So it means that the land is currently used for the industrial purpose. But market would see a kind of alternative. In that sense, market would perceive that, so if you use this land for residential purpose, so that is where they can obtain the maximum benefit. If the market thinks like that, then they would find uh, the, the benefit what they are thinking, it mainly comes from the land alone, not in combination. But instead, if the market perceives that we can make the maximum, we can maximize the profit if we continue to use this particular land for the industrial use, or which is the current use. If we continue to if we continue the current use, if we can make the best out of that, that is the in combination. In the sense, if you continue the factory which is located in the land, then that is going to be the in combination. You're taking the benefit not principally through the land itself, but through the factory which is already located there. So that's what the in combination. Yes, in combination land with factory. Standalone use the asset for residential purpose. Yes, very correct. So this time you are getting it correct. Yes, when it comes to these purposes, you know, if you are to use this land for the residential purpose, certainly you have to, the market would assume that they need to demolish this building, and they are primarily taking this land and thereafter doing the construction. So therefore, they have principally seen the benefit through the land itself. තොර මාකට් එක මේක දැක්ක ගමන් හිතන්නේ මේ තියෙන බිල්ඩින් එක කඩලා දාන්න ඕනේ. මේ ෆැක්ටරි එක කඩලා දාලා ලෑන්ඩ් එක අරගෙන දැන් අපිට අවශ්‍ය විදිහට හදාගමු residential use එකට. And therefore they have primarily seen the benefit out of the land. But when it comes to the in combination, what they would see that they think of continuing this as a factory. Like a factory එක විදිහටම කරගෙන ගියොත් අපිට මේ land එකේ හොඳම benefit එක එන්නේ එතකොට. So we continue it as the industrial use and then we would make the most out of the land. So මේ land එකට යොදවන්න පුළුවන් හොඳම විදිය තමයි factory එකක් විදියට run කරන එක. එතකොට factory එකක් විදියට run කරනවා කිව්වොත් එතකොට අපි benefit එක දකින්නේ business එකක් විදියටනේ. So it is not just the land but together with the rest of the asset we are seeing it in combination. Land එක විතරක් නෙමෙයි land එකට factory එකත් එකතු වෙලා මේ ඔක්කොමත් එක්ක තමයි වටිනාකමක් පේන්නේ. That's why we call it in combination. Right? So therefore we are looking at the land in that particular perspective. Yes, as you have mentioned that continue for the current use, namely as a site for the factory, and the factory would continue to operate. Factory එක දිගටම කරගෙන යනවා කියලා අපි හිතනවා. It's in combination. Fair value of both the land and factory based on the selling price, the assets to the market price, who use this asset for the industrial purpose in conjunction with their other assets. එතකොට fair value එකක් දෙන්නේ මේ land එක සහ factory එක කියන සියල්ලම consider කරලා එතනින් අපිට land එකට අවශ්‍ය value එක කීයද කියලා වෙන් කරලා ගන්න පුළුවන් if we really need to do that. But or otherwise, if we would find that make it to a vacant site for the residential purpose, that is another possible use, and it is a standalone one. In that case, the fair value of the land calculated net of cost of demolition of the factory and other cost of conversion to a vacant site. So එතනදී අපිට consider කරන්න වෙනවා land එකේ fair value එක. ඒකෙන් අපි demolition cost එක, we have to demolish the factory, the demolition cost and the other cost of converting that to a vacant site must be considered. So මේ අවස්ථා දෙකේම වැදගත්ම කාරණාව තමයි we are valuing the land. අපි value කරන්නේ land එක. Right? That is the most important thing. We need to establish the fair value for the land. But we are taking two different approaches. This time market would place a value for the land itself. This time the market would place a value for the land and factory together. Together as a business, they are placing a value. Once the market is placed a value as a business, what you need to do is you need to so somehow take a particular valuation for this land. Land එකට කීයද කියලා ඔයා ඒක pro rata basis or whatever the suitable basis, you need to get the particular value. And that is the most important thing, right? So it is about the determine the highest and best use of the land. And also these are hypothetical transaction. These are not actual transaction. So making කියවෙන්නේ නැහැ මේ ඇත්තටම අපි factory එක කඩලා දාලා විකුණනවා කියන එක නෙමෙයි. So we are assuming මෙහෙම වුණොත් මේ විදිහටයි value එක ගන්න වෙන්නේ. In combination නම් මේ ඔක්කොටම අදාළව value එක කීයක් දෙයිද? ඒ value එක අපි suitable විදිහට land එකකට ගන්න ඕනේ, right? Okay, in combination, yeah. What happens if the company is using the land its best use currently? Yes, that's fine. That's totally fine. Let's say that out of these two uses, the current use is the best use. That is perfectly fine. No problem with that. So it is the current use has become the highest and best use. It is pretty okay. So then the current use, which is the site for the factory, so it is the current use and that is the highest and best use. In that, you need to take this particular valuation. So out of this, which gives you the highest value for the land is what you must take. So මේ දෙකෙන් වඩා වැඩි වටිනාකමක් දෙන එක තමයි ඔයා හඳුනා ගන්න ඕනේ fair value එක විදිහට. අපි හිතමු මෙතන land එකේ වටිනාකම consider කරලා ගත්තාම let's say that it is 10 million, and here let's say that once you consider the fair value and considering the demolition cost and the other, let's say it is 8 million, then out of that the highest and best use is 10 million, so therefore the fair value is 10 million, right? So once you decide the highest and best use referring to that, take the fair value. So ඒ දෙකෙන් වැඩිම use එක තීරණය කරලා ඒ use එකට refer කරලා fair value එක ඔයා ගන්න ඕන, right? Okay. So it doesn't matter how you currently use it or not using it. Hope that is clear to you. This is the most important thing that you need to identify other than the principal and the most advantageous market what we discussed. So because this is certainly going to be a test, I would say. So your clarity is pretty much required. So if there's anything that you would like to get clarified, yes, now it is the time. Ek මොනවද clarify කරගන්න තියෙනවද දාලා? Yes.
So there is a question.
Yeah.
So if there is no any factories or any building in the land,
Okay.
so what happens about, I mean, I'm asking about the valuation methods in combination or standalone.
Yeah, you're talking about a kind of just a kind of land. It's, let's say it's a vacant land, no?
Yes, sir.
Yeah. Let's say, yeah, let's put it like this. Let's say that currently you make a kind of investment. Let's say that you have some money with you, so therefore you just go and purchase a land for your business. So therefore it's a kind of a vacant site. The land is currently vacant site. Yes, then again what you need to do, you need to look for the alternative uses. So the market, it is all about how the market would perceive. So there can be a segment of the market would perceive that this land can be used for the agricultural purpose. So depending on that, they may bid a particular price. There can be a segment of market, they would think that, okay, this land, we can use it for residential purpose. And depending on that, they may bid a price. And there can be another segment of the market, they may think that, okay, we can construct a factory over here and we can make some use out of that. So it's an industrial use. So therefore, there is a segment of the market, think of taking an industrial use out of that. And depending on that, they may bid a particular price. Now you have three options, no, for your land. So the market perceives that there are three users. So out of these users, they are basically the standalone users. So not in combination, because currently you are not occupied that for a particular purpose. So therefore, all the users what I mentioned, those are standalone users, because primarily the market sees the benefit from the land, right? So therefore, out of these three users, what gives you the highest benefit? That is the highest and best use. So in that instance, it is pretty much straightforward, I would say. Is that clear?
Yes, sir. Clear.
Yeah. In combination mean is that currently it is occupied for a particular purpose. So that's why I told you it is a in use. So currently if it is occupied for a particular use, that is what we call the in combination, right?
Sir.
Yeah.
So if we use that land for parking facilities, then?
Yeah, it is currently occupied for the parking facilities. But again, you would find that still we are taking the benefit mainly out of the land. No any construction or anything over there, no? It's a current use, yes. It's a current use, but not in combination. So it is just the land being occupied. So therefore, it is primarily you are taking the benefit out of the land itself. So again, it is standalone. Yes, it is true that it is the current use, but it is standalone, isn't it? So it has to be, for it to be a kind of in combination, there must be a kind of a factory or residential apartment or something. Or I would say that there must be other assets together with the other assets. If I just go back to that, here what it emphasizes is that the asset what we consider is used together with the other assets and liabilities. That's the most important thing. So it is, I would say, primarily the business. So that is the distinguishing point. So you need to consider that here the asset alone, standalone, or primarily taking the benefit out of the land, or in combination mean that that particular asset must be occupied together with the other assets. So as you mentioned, so therefore, yes, you are trying to make a distinction about, as I said that it is the current use is in combination. Yes, the current use can be even the standalone use, as you have very correctly highlighted. So therefore, we cannot straight away say that it is the current use. I was just trying to simplify that, saying that in combination is current use. But as you mentioned, the current use can be even standalone. So therefore, we need to stick to this. In combination mean it is together with the other assets and liabilities. Good. So good thinking, appreciated, right? Hope you are getting the point as well.
Yes, sir. Now clear.
Yeah, good. Very correct. So it is all about the principal question that you're asking. Are we taking the benefit principally out of the asset, or are we taking the benefit together with the other assets and liabilities? So that is what we call. Good. So appreciate, right? You're thinking on that. That is what I appreciate the most. Step 3, we are moving on to determine the principal or most advantageous market. So when it comes to the four-step model, the first 2 steps we discussed, it is about the assets and liability, the characteristic of the asset and liability, then the valuation premise. It may be either in combination or standalone, which gives you the highest and best use. Now it's about the market. In fact, we have already discussed that. So when it comes to this, the market, you need to refer to the principal market. If you are to decide the fair value, you must refer to the principal market. Or in the absence, you must look for the most advantageous market. In fact, we have discussed this. The fair value measurement assumes that the transaction takes place in either the principal market or the most advantageous market. So it says that in order to decide this principal market or the most advantageous market, it is said that you need not to make an exhaustive search. So usually it is assumed that the market in which you enter into the transaction frequently is going to be your principal market or the most advantageous market. So therefore you need not to take kind of exhaustive search. The market it usually sells in is presumed to be the principal market unless contrary evidence exists. Right? සාමාන්‍යයෙන් අපි කියනවා අපි exhaustive search එකක් කරන්න ඕනේ නැහැ මේ market වලට. සාමාන්‍යයෙන් අපි usually transact කරන market එක තමයි principal market එක කියලා. හැබැයි අපි සැලකිලිමත් වෙන්න ඕනේ unless contrary evidence exists. So in the sense that if you are provided with the market volumes of the transaction, then obviously you need to refer to the market with the highest volume. That is going to be your most advantageous, sorry, the principal market. So, but usually in a simple sense, we say that it is the market in which you usually enter into transaction because it is going to be your principal market. Right. So, and finally, it is about determining the appropriate valuation technique. So when it comes to deciding the fair value, so in fact, there are 3 approaches what you can take. So out of that, if I want to say that the most desirable approach, it is going to be the market approach. In the sense, you are taking the fair value from the market. For example, so in a country like Sri Lanka, we have the share market. So when it comes to the shares are considered to be the identical asset. Shares are considered to be the identical asset. So the price generated by the market transaction involving identical asset or liabilities, it is the market approach. So එතකොට අපි දැන් shares වගේ දෙයක් ගත්තොත් අපි දන්නවා one share is in all the aspects is equal to another share of the same company. So එකම company එක share එකක් අනිත් share එකට සෑම අතින්ම සමාන වෙනවා. එතකොට අපි ඒවට කියනවා identical assets කියලා. So if you have a price generated by the market for identical asset, that is going to be the most suitable fair value. That is the most reliable fair value. තමයි විශ්වාසය අතින් ඉහළම fair value. So the example that we can take in our context is only the share market. So therefore the price of the share which you obtain, the quoted prices in the market is the most desirable fair value. So therefore we have the highest reliability when it comes to the shares. So the market approach is you are taking the price from the market. But in most of the instances, you would find that the identical assets are not there. In a developing country like Sri Lanka, we have only instance for the identical asset that is going to be the shares. But in the advanced market, there may be certain identical assets. But most of the time, what we find here is that it is comparable assets. If you take land, the land cannot be identical. If you take buildings, it can't be identical. So most of the time, it may be the comparable assets. If you take the motor vehicle, so if you take the used motor vehicles, right? Used motor vehicles, it's going to be comparable. It is not identical. So even for these comparable assets, you may find that in the market, you can get some prices. For example, if you want to take a price for a motor vehicle of yours, let's say that you have a Toyota Corolla, right? A particular year, say that it's 2015 or something, the model that you have, and it is a particular number of kilometers is done, let's say, then in the market, so if you search through the web, you may be able to locate a price. You may be able to locate a price for that particular model. You know, whatever the model, there's a market price, right? Then taking that market price, you can do certain adjustments. You can do certain adjustments because the mileage is different, the maintenance is different. Likewise, there can be certain differences. For these differences, you can make some adjustment, and you can decide on a price. So this is exactly what you do when you are selling a particular vehicle නේ. එතරම් ප්‍රායෝගිකවත් කරන්නේ ඒ දේනේ. මාකට් එකේ යම් කිසි price එකක් තියෙනවා. ඒ price එකකින් පටන්ගෙන අපි යම් adjustments කරලා අපේ asset එකේ තියෙන conditions වලට අපි මේ asset එක sell කරනවා. ඒකට basically market එකේ prices available වෙනවා comparable assets වලට. ඒකට ඒකත් market approach. So if you can basically generate the prices from the market transactions, just that is the market approach. And it is said that this is the most desirable approach to get the fair value, right? There can be quoted prices, or sometimes there may be the prices other than quoted prices in the market. So you may be able to take that. Then there may be certain instances where you may find that the market information is not there. Say that there is a particular kind of machinery which is pretty much unique to your entity, or let's say that it's a kind of customized machinery. So if you take a kind of customized machinery, certainly you cannot sell that in the market. So in other words, the market participants may not find any benefit out of that. So it doesn't make sense to the market. So if it is a kind of a customized machinery. But you know, machinery, it's a PP item. So if you really want to fair value that, then how do you do that? So can you say that, no, we cannot sell this in the market, so therefore we cannot go for the fair value? No, that should not be the way. So you can think of an alternative. Instead of the market approach, what about forecasting the future cash flows and get them discounted by a particular market rate? Maybe the lease rate, right? You may be having a particular asset which is having usually a 10-year useful life, and let's say that you have used it for like 4 years time, and now you really want to fair value that. So in that particular instance, what you can do, you can forecast the cash flows for the remaining 6 years and get them discount by a market rate, right? Get them discount by a market rate. Maybe the lease rate, right? Lease rate for a machinery of that nature, and get the value today, and that is going to be the income approach. So it is more or less similar to the value in use, what we discussed, if you are to think of. So you can remember that from the very beginning, we discussed about the value in use. So this is exactly the value in use, but remember, though it is value in use, so here we are taking a market orientation. In the sense, when it comes to entity specific use, you are taking a kind of discount rate that is applicable for that particular entity. But here we are taking a market discount rate. So thereby we are making this a kind of a market orientation we are giving. So therefore the income approach is an alternative to the market approach. Or otherwise, it is said that even you cannot make sense out of the market approach, even if you cannot use the income approach, the other sensible way is that the cost approach. So අපිට යම් කිසි asset එකකට අදාළව market approach එකක් use කරන්න බෑ, income approach එකක් use කරන්න බෑ. එහෙමනම් මොකක්ද අපිට තියෙන option එක? We can go for a cost approach. So what is the cost approach? It is the replacement cost. Let's again say that there is a kind of a unique machinery, right? There's a kind of a unique machinery. So you want to revalue that. So when you're going to revalue that, you find that you cannot sell them in the market because it's unique. And you find that it is difficult to forecast the future cash flows. So depending on that, still you want to revalue that, you want to fair value that, then how you do? What you can do is that you can approach the manufacturer of that particular machinery, right? There's a person who manufacture that, right? Still that particular person may be able to manufacture that. Then you may ask, if I want to get a machine similar to this today, how much would it cost? Then he would say that a particular price may be offered. Let's say that you got this machine done 3 years ago. At 3 years ago, you got this machine done for 10 million. And it was said that this machine can be used for 5 years. අපි හිතමු මේ machine එක අපි මීට අවුරුදු 3කට කලින් හදව ගත්තා. අවුරුදු 5ක් use කරන්න පුළුවන් කිව්වා. Assuming no residual value, if you depreciate that per annum, you may be depreciating 2 million. 10 divided by 5. So therefore, you have used this machine for 3 years. In the sense, you have depreciated this 6 million. So the carrying amount of this asset is 4 million, right? Then how you are to get the current cost of this machine, or I would say the current replacement cost. It's like this, no? You have a particular machine, you have purchased it for 10 million 3 years ago, right? 3 years ago, and the useful life is 5 years. 5 years useful life. So this is the case, right? So then currently, if you look at the carrying amount today, is 10 million minus its per annum depreciation 2 million into 3, it is 6 million. So thereby the carrying amount is going to be 4 million. 4 million, right? There are 4 million carrying amount. So this is the machine what you want to depreciate. This is the machine what you want to revalue. So in that, what you can do today, you can go to the manufacturer, you can approach the manufacturer and you can ask for what is the price that it would cost if I want to get a similar machine done today. Then he would say that if you have to get a similar machine done, it would cost you 15 million. Considering the inflation and the other factors, he would say that if you have to get a brand new machine done, it costs you 15 million. But the thing is that the machine what you have today, it is a kind of machine that you have used for a certain period of time. So therefore, the brand new machine may not be equal to the machine what you may have. So therefore, you need to do a kind of a adjustment for that. So you can do a kind of depreciation adjustment, right? So the machine what you have is 60% depreciated. It is 60% depreciated. So therefore, if you have to bring the brand new machine to an equal condition, what you can do is you can depreciate this 60%, right? It is 60% depreciated. And now, if you get the value, and that is going to be the fair value. And this is what we call the replacement cost. Replacement cost, sorry. Replacement cost. So make a fair value. And what is the approach? That is the cost approach. So you can see that there's a revaluation gain of 2 million. This is the carrying amount. This is the revalued amount, or it is the fair value. Then how do you establish the fair value? That is through the depreciated replacement cost, right? That is another approach that is available for the fair value if the market approach and the income approach is not available. But it is said that it is the reliability, as far as the reliability of each of these approach is concerned, it is getting low. So when you switch from the market approach to other approach, the reliability of the fair value is compromised, right? So if you go for the income approach or the cost approach, the reliability could be less, right? But the market approach, it is a highly reliable source. So in the market approach, it is the most reliable one is the market prices, the quoted market price for identical assets. So in a country like Sri Lanka, the only instance we have the identical assets, the market for identical assets, that is the share price, right? Okay, it is about the different approaches. So when it comes to a particular asset, you need to decide out of these three approaches, which approach gives you the best fair value, best estimate for fair value. So it is the fair value market approach is more desirable. The income approach, then only if the no option is there, you can go for the cost approach, right? So the problem is that when you're moving away from the market approach to income approach and cost approach, here the entity specific, this tend to be, the fair values tend to be more entity specific. So when it comes this cash flow forecast and the replacement cost, all these things tend to be more entity specific. So that is the risk involved over there. Then for each of these approach, you need to have a certain input. You need to have input to these valuation techniques. So if you take this market approach, you have certain inputs, right? If you take this cost approach, you have the certain inputs. And if you take similarly the income approach, there are certain inputs. So inputs is basically refer to the broadly the assumption that the market participant would use when pricing the asset or liability, including assumptions about the risk. So normally, why cannot use income approach in practice? Yeah, income approach can be used. The problem is that, as I said, it is about the subjectivity that it involves. So when it comes to market approach, that subjectivity is less. So here it involves some, we call it that unobservable inputs. You know, prices in the market, it is something observable. No, it is there in the market. You can observe that. But when it comes to the income approach, you rely on something that you create. The cash flow forecast, that is the main input. This cash flow forecast, it's something that you predict, right? So when it comes to this prediction, the subjectivity is high. Those are estimates. So therefore, the reliability of the fair value that is compromised. So that's why we are not prefer the income approach over the market approach. The market approach is the most preferable one. But only in the absence of the market approach, market data, we are looking for the alternatives, right? That is the reason it is the subjectivity of the estimates. Got it? Good, right?
Sir.
Yeah.
So if we can't, I mean, expect future cash flows in the, income approach. So does it indicate that the indication to amortize or depreciate an asset?
You mean that? So here, basically, you're asking that why are we switching to a kind of cost approach? Is that the main consideration of yours?
Yes. Still, we can't expect future cash flows.
No. That is not the case. If the future cash flows is not there, definitely there can't be any asset. So the problem is that the future cash flows are there, and we find it is difficult to forecast that. It is a kind of a difficulty what we face. That's why we are moving to the cost approach. Certainly, the future cash flows must be there. And the problem what we have is that we may find it difficult to forecast. So depending on whatever the resources we may have, right, we may find it difficult to forecast. Because of that, we are taking a different approach, cost approach. So when it comes to the cost approach, we are talking about an asset what we have used for a particular period of time, right? So because of that, to reflect that particular use, we are doing an adjustment, right? If I'm to share that, yeah, now you see that this asset is we have purchased 3 years ago. So therefore, currently, if you look at the carrying amount is 4 million, no? And this is the asset what you want to revalue, what you want to fair value. In that case, what you do, you would consult the manufacturer and you get the price. And he would say that, okay, I can do a similar machine, but it will cost you 15 million. But the thing is that it is a brand new machine. It is not comparable to the machine what we have. The machine what we have is a 60% depreciated one. So therefore, to bring this brand new machine to a comparable state, we are applying that depreciation to this brand new machine. Then only it comes to a comparable state. That's what we did. So that is to reflect the usage, the wear and tear, the obsolescence. So in order to reflect the obsolescence for a period of 3 years, we do this depreciation. That is the purpose. Got it? Okay, good. Right. So likewise, it is good that you may come up with the questions.
Sir, there, excuse me, sir.
Yeah.
In the income approach method,
Yeah.
for the future cash flows, it is very difficult to calculate the future value for the income approach, no, sir. So we can use some other methods, the discounting factors approach method for the calculation of future value for the
Here
present
we are
value.
when come to the income approach, by forecasting the future cash flows, we need to discount them and take the present value today. That is what we are called the income approach, right? It is not just about future cash flows. It's about converting the future cash flows to a single current amount. Is that clear?
Yeah, now sir told that no, the
Yeah.
income due to the lack of response
Resource.
in the income approach, we
Yeah.
go for the cost approach like that. No.
Yeah.
So that is
If you
why I'm
find that
asking.
the forecast in the future cash flows is difficult from a particular asset, then only you must move to the cost approach. Yeah, that's what I said. Yeah. Okay.
From the cost approach, we can go for the future value also. Because if we assume the cost approach as the present value, we can go for the future value by discounting them. That is the way I'm asking. Both
No.
approaches are suitable, whether suitable or not.
No.
Are
So
there any?
basically, the cost approach here. No. Yes, you are saying whatever. What you are saying is there's a point in what you say. But when it comes to this cost approach, what the basic argument is that the amount that would be required currently to replace the service activity or service capacity of that particular asset. So when it comes to a particular asset, there is a particular service capacity, right? So it can generate certain benefit. So in order to replace that, how much would it cost for us? That is the fundamental question it asks. So in that sense, we cannot think of the future cash flows and get them discount. But what you say, there's a point, because whatever that we are ready to pay today, is equal or more or less similar or more or less equal to the benefit what we may be getting out of this particular asset in the future, right? Because we are assuming kind of a very rational behavior, rational economic behavior. So therefore, what we are ready to pay today must be a reflection of what we are ready to receive in the future. So in that sense, yes, it makes sense. But
Based on the discount impact.
Yeah.
Okay, thank you, sir. Thank
Yeah,
you.
good.
Thank you,
So very good, right? Your thinking is pretty much appreciated. So that is what it is required the most. Do we need to get the expert assistant in 3 approaches, or can we do by ourselves? Yes, usually it is said that so if we can so rely on a kind of expert knowledge, so that is more desirable, because you are relying on a kind of expert is that so that itself adds some reliability to the figures. But when come to the standard does not necessarily says that you need to take the service of a kind of a professional. That is not a kind of requirement. Even using the in-house capabilities, you can go for that. But the thing is that all these figures subject to audit. So hence that also helps to add some reliability. So therefore, let's say that you do this in-house using the resources what you have in your organization, but no problem, because this is taken through a kind of audit. So therefore, the audit may question how you have done this fair value. They may evaluate the inputs, whatever the things, whatever the approach. So hence, the reliability must be ensured. But if you can take the service of a professional, then it is not questionable. So it is rarely questioned by the audit. So therefore, it is something up to you. So here, I must say that if I'm to relate this to the last week discussion, this is an area where the manipulations are possible. So this fair value, this is the area where the manipulation it seems to be possible, because the lot of judgment is involved, isn't it? So you think that when it comes to fair valuing, it's more about the professional judgment, right? Good. So you must see the big picture. Good. The input this is what I was talking about last. This is basically the inputs to the valuation techniques. So under each of these valuation techniques, you have seen that. So we are using certain assumptions that the market participant would use when pricing the asset. And basically, these inputs can be divided into 2. We call it observable inputs and unobservable inputs. Observable inputs are the inputs that are developed based on observable market data and reflect market participants' assumption. In simple words, putting simply, observable inputs are the inputs what you can observe in the market. In the sense, under the market approach, we discuss about the market price. So the market price is a observable input. Say for an example, if you take the share prices is a input to the market approach. So you take this share price and you get them multiplied by the number of shares and you get the value for a particular investment. So therefore, market price, the number of shares that you have, those are market observable inputs. And similarly, when it comes to valuing, let's say it's a land, when it comes to this land, there's a price you can work out for a price for a perch of land. So in that, you can take the number of perch that it is there in a particular land and you can get them multiplied and you can work out that. That is also observable, right? The price per perch of land. And even for the vehicles. So you would find that in the market, there's a particular price for a particular model, for a particular year, there's a price. Then taking that price, you can make some adjustment considering the conditions of your asset and you can get that. But still, the price is observable in the market. So, and also the market interest rate, that is also a observable one. So therefore, basically, under the market approach, whatever the inputs that you would have, we call them observable inputs. Observable inputs. Then what about the unobservable inputs? The inputs for which market data are not available and which are developed based on the best available information about the market participants' assumption. So therefore, when it comes to this income approach and cost approach, here you get the future cash flows. Is it something available in the market? No, it is not available in the market. It is unobservable, right? It is something that you work out based on the estimates, right? So it is something that you, based on the best available information, that is something you work out. So therefore, the future cash flows, it's a kind of a unobservable input. And similarly, when it comes to the cost approach, so here you would consult a kind of a manufacturer and you get the price information. So still it is not something available in the market. It is something that you would generate. So therefore, that is also unobservable input. So therefore, when it comes to the income approach and the cost approach, you would find more unobservable data. But in the market approach, the inputs what you would take is something observable in the market, right? Then there is a hierarchy. So you can put this input into three categories called the level 1 inputs, the level 2 inputs, and level 3 inputs. Then out of that, in a given situation, what you must try to do, you must try to maximize the use of observable inputs and minimize the unobservable inputs. So if I'm to take these levels, this level 1 and level 2, basically we call it, that is the observable inputs. Level 3 is what we call the unobservable inputs. So if I'm to draw a relationship between this. Now you must see the clear picture. Market approach, you have the observable inputs, and in that, level 1 inputs and level 2 inputs are there. When it comes to the income approach and cost approach, you would find predominantly the unobservable inputs, and it falls to the level 3 inputs. So what is the level 1 input? This is the most reliable input. It is the quoted prices in active market for identical assets and liabilities. The classic example in our country, that is the quoted prices of shares, the quoted prices for shares. So this is the most reliable input. So it comes under the market approach. It is the highly observable data, right? The most reliable one. It is the quoted prices for in the active market for identical assets, right? Identical assets. The assets must be equal in all the aspects. Active market, the market, there must be frequent market transaction and the prices are available on a continuous basis, and it is quoted price. The level 2 input other than quoted prices included within the level 1 that are observable for the asset or liability either directly or indirectly. You can observe that directly or indirectly, but it is the prices other than the quoted prices in the active market. So therefore here you can take the quoted prices in inactive markets and also the prices for similar assets, right? There can be prices for similar asset like motor vehicle and land, you can take them. So likewise, that is level 2 inputs. When come to the level 3, those are basically the unobservable inputs. You cannot see that. It's about the future cash flows. It's about the cost information, the replacement cost information. Those are unobservable. So, and even the interest rate, what you would work out, right? So the things basically not available in the market. So I would say that, to putting it simply, the things that may not available in the public domain, putting it simply, something like that, right? Right. Level 1 inputs commonly used for assets such as brand new motor vehicles. Those are basically identical. So for the brand new motor vehicles, we can have the kind of quoted prices, brand new plant and equipment, and also the publicly traded shares. The level 2 inputs commonly used for assets such as land and building, right? You don't have the identical land or building, but the similar land and building. So if you are to work out a price, then you can start with the price of a similar land, then you can work out the price for yours. And similarly for motor vehicle, you can do the same, not the identical motor vehicle, but the kind of similar ones. The level 3, basically, when it comes to valuing the trademarks, you can forecast the future cash flows and get them discounted and get the value, and account receivable and cash generating units. So you can forecast the future cash flows and get them discount and get the values. Yeah, that is going to be the level 3 inputs, unobservable data. Okay, so this is about the kind of discussion what we want to have. So this is a summary of what we have discussed today. So it's about the measurement, it's a fair value, it's exit price, it's current and specific, principal or most advantageous markers, highest and best use. The fair value, it's about the market, the techniques we have discussed, and inputs for these techniques were discussed. Right. And this is a kind of activity what I want you to attempt. So let me simply let you to attempt this, and in the next lecture what I would take, I may summarize this, right? So today I think we have already gone the time, sorry for that, and yeah, so you can try this and we will discuss them in the next class, right? Okay, then that's what I wanted to discuss for the day, and I'm sorry that I'm always taking more time than expected. I'm sorry for that. I'm going into more explanation, so it's typically, and sorry for that. Yeah. Anything that you would like to get clarified from the ones we have discussed? It's about the inputs from the input section. Anything that you would like to get clarified? Okay, at the moment, fine, right? Okay, then thank you very much. So see you in the next class. So let me upload the video recordings, and good night.